Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a chart of the volatility index for the CBOE. That's ticker symbol VIX. And I'm starting off with this one because last week I said the VIX would most likely drop and we were getting conflicting signals. But the VIX has always been, for me at least, a leading indicator. And last Friday I said that the VIX was showing a bearish engulfing pattern here and we would most likely go lower before bouncing. And look at this. On Wednesday we formed this doji and bounced on that day, followed by a green candle. And now guess what? We have a red candle that I am labeling a bearish engulfing pattern. Now, the reason I'm saying it that way is because last week on YouTube, I saw a comment from someone that was basically questioning my definition of an engulfing pattern, basing their definition on what Steve Nissen has labeled as a engulfing pattern. The way Steve Nissen describes it is a two-day pattern found at the end of an up leg or an uptrend. And I have used this engulfing terminology for many, many years. I am a trader. My version of an engulfing pattern might be slightly different than Steve Nissen and maybe more aligned with another very credible expert in technical analysis, candle patterns, is Steve Bigelow. Now, Steve Bigelow and Steve Nissen have both been on my PBS show years ago. I lean more towards Steve Bigelow because he's a trader. He puts his money where the signals are, and without undermining Steve Nissen, of course, and his expertise, Steve is more of an educator, not so much a trader. So when I'm trading and I see a two-day pattern like this where you have a long red candle engulfing the previous green candle, of course I put more weight into a bearish engulfing pattern that's the end of an upward leg. But a two-day pattern with a big red candle engulfing the previous day, I label that as engulfing pattern. And from my records, 80% of the time, we tend to drop after this. So here we are seeing another pattern. We didn't quite hit my target on the VIX, but this pattern is telling me the VIX could go a little bit lower. So I'm going to erase this line right here, and I'm going to forecast this for the VIX. Another down week. At least at the beginning of the week, you could see that the CCI is turning lower and the stochastics is kind of flattened out in the oversold condition. It could stay there for a little while actually, but as I back up, you'll see that the VIX is right at a key support level from the lows back here on the 3rd of March. So I do believe that the VIX is going to go down there to test that support level, and being that is a contrarian indicator to the S&P, that is a short-term bullish sign for the S&P. Now, we did not move lower like I thought we would. We in fact broke out over this resistance right here, and we are now pressing another gap fill point right here. See this? So we're at a gap fill resistance right there, but we're slightly over it. So we could see a little bit higher on the SPY as we test this secondary resistance up here. And you can see that as I zoom in, the increase in volume on this green candle is telling me the buyers are moving in. The stochastics still hovering and overbought, while the CCI is showing some conflict with the stochastics, but I'm going with the price pattern and I'm going with volume because if you follow along with our trading checklist, price and volume take the top two spots as far as priority is concerned, and then the other oscillators support that. So we don't have all of these signals lining up on the buy side, but I do think we could go a little bit higher before we pull back, and that's the spiders. Now looking at the Qs, this is more or less the tech sector. Look at this. We're almost at record highs. Can you believe that? After the major sell-off in February and March, we have recovered almost all of this. And that's telling me that the buyers are showing some resilience. But with that said, as I erase these lines, we are approaching that record high, which will most likely act as a resistance level. And as I gravitate down to the bottom of the chart, notice this. We have higher highs coming up on the Qs, but notice how we're having lower highs on the CCI. That's a negative divergence. So while I think we could go up to press that resistance, the charts are basically telling us that if you take any new long position, the best advice is to what? Protect, protect, protect. Use trailing stops. Put your stops below this key support level right here, which is a gap fill support level, and make sure you're managing risk, because on a dime, this market can turn and leave you with a loss, and you don't want to do that. You want to minimize the losses. Now, if we look at a more broad-based index, Russell 2000, look at that. We broke out over resistance. We didn't pull back to the moving average. However, I'm going to erase these lines, and I'm going to redraw this roll reversal support. Once resistance is broken, it turns and reverses the roll, turns into support. This is a long shadow underneath that candle. Therefore, I think we're going to go up in the Russell 2000, even though the oscillators are pointing lower. So ultimately, once this gap is filled, and it is, if we see any trading above this, this too could turn into a roll reversal support level. But we're stuck in a very narrow trading range right here. And the Russell 2000 being a small cap index, this one could go either way. I'm not going to put my money too hard on either side of the market, but for the option traders, this is money being made in time erosion, time spreads, things like that, where time erosion and time decay take its toll on the price of options, and you can make money even in narrow channels like this. So we have too many mixed signals on the Russell 2000, but I am leaning more towards a short-term rally before we pull back. I don't even know if we're going to get as high as that target because we have this resistance up here, but keep an eye on the charts and again, manage risk. Now, if we look at the diamonds, ticker symbol DIA, it's really the same story, although the diamonds are a little bit different than what we've seen, because although we have a shadow under here, we have a gap below here. See this? I think the diamonds could do something a little bit different than the other markets, and I'm going to erase this line right here, and I'm going to draw it right here as a roll reversal support that is also a gap fill support. So I think the diamonds could very well pull back to fill that gap and then bounce. So again, I'm not thinking earth-shattering rallies by any stretch, but if you take a look back, you know, we've recovered more than half of what we lost in February and March, and I think the markets are going to do well long term. But for the traders, you got to manage your risk and look at this volatility, because it's going to continue to oscillate and giving us all kinds of trading opportunities. So I don't want to go too far in one direction this week because it really could go either way. In the meantime, we're going to follow the charts, look at the signals, follow the trading checklist, and make sure you stay tuned to the market, guys. Have a great weekend. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.